Money management can be difficult, and it's easy to make mistakes. But by being aware of these common pitfalls, you can take steps to avoid them and improve your financial situation. In this video, we'll show you the 5 most common financial mistakes and how to avoid them. Mistake number 1. Not having a budget. One of the most common financial mistakes is not having a budget. A budget is a plan that helps you manage your money and keep track of where it's going. Without a budget, it's easy to overspend and end up in debt. It's important to understand that not having a budget is not the same as not having any money. It's simply not having a plan in place to manage the money you do have. Making a budget can be difficult, but it's actually quite simple. Start by listing all of your income, including your salary, any bonuses or commissions, and any other sources of income. Next, list all of your expenses. Be sure to include all of your fixed expenses, such as rent and utilities, as well as your variable expenses, such as entertainment and eating out. Once you have a complete list of your income and expenses, you can see where your money is going and where you may be able to cut back. Sticking to a budget is one of the most important aspects of budgeting. It's easy to create a budget, but it's much harder to stick to it. To ensure that you stay within your budget, set yourself reminders, such as calendar alerts, to check in on your spending. If you find that you're consistently overspending in certain areas, make adjustments to your budget to reflect that. It's important to review your budget regularly. As your life changes, so will your income and expenses. It's important to adjust your budget accordingly. This can be done monthly, quarterly, or even annually. One of the most important things you can do to gain control of your finances is to create and stick to a budget. Not having a budget can lead to overspending and debt, but with a budget in place, you can manage your money more effectively and achieve your financial goals. Mistake number 2. Not saving enough for retirement. Another common financial mistake is not saving enough for retirement. Many people think they can wait until later in life to start saving, but the earlier you start, the more time your money has to grow. The power of compound interest is something that can work in your favor if you start saving early. It can help you save less, but still end up with a larger nest egg. Retirement may seem far away, but it will be here before you know it. And the earlier you start saving, the more time your money has to grow. Even if you can only afford to save a small amount, it's better to start now than to wait. Consider setting up automatic contributions to a retirement account, such as a 401k or IRA, to make saving easier. This way, you won't have to think about it. The money will automatically be transferred from your checking account to your retirement account. It's also important to understand the different types of retirement accounts available to you. A 401k is typically offered by employers and allows you to save pre-tax dollars, while an IRA, individual retirement account, is an account you can open on your own. Both have their own set of rules and limits, so it's important to understand the differences and choose the one that's right for you. Another key aspect of saving for retirement is having a plan. Have an idea of how much you need to save and when you want to retire. You can use online retirement calculators to help you determine how much you need to save based on your current income and expenses, and how much you'll need to live on in retirement. Saving for retirement is one of the most important things you can do to secure your financial future. It's never too early to start, and even small contributions can make a big difference over time. Consider setting up automatic contributions to a retirement account and have a plan to reach your retirement goals. Remember, the earlier you start saving, the more time your money has to grow, and the more comfortable your retirement will be. Mistake number 3. Carrying too much credit card debt. Carrying too much credit card debt is another common financial mistake. Credit cards can be a great tool for building credit and making purchases, but they can also be a dangerous trap if not used responsibly. High-interest credit card debt can quickly spiral out of control, leaving you struggling to make payments and damaging your credit score. To avoid this mistake, it's important to use credit cards responsibly. This means only charging what you can afford to pay off in full each month. Carrying a balance on a credit card can lead to high interest charges, which can add up quickly. By paying off your balance in full each month, you can avoid interest charges and keep your credit card debt under control. If you already have credit card debt, it's important to create a plan to pay it off as soon as possible. One way to do this is by consolidating your debt. This means taking out one loan to pay off all of your credit card debt. This can help you get a lower interest rate, which can save you money in the long run. Another way to tackle credit card debt is to negotiate with your credit card company for a lower interest rate or to set up a payment plan. It's also important to monitor your spending habits and try to avoid incurring credit card debt in the first place. One way to do this is by setting a budget and sticking to it. Another is to only use credit cards for necessary expenses and avoid impulse buys. Carrying excessive credit card debt is a common financial mistake that can quickly spiral out of control. To avoid this mistake, use credit cards responsibly, pay off your balance in full each month, and create a plan to pay off any existing credit card debt. Consolidating your debt or negotiating with your credit card company for a lower interest rate can also help. Remember, the key is to be mindful of your spending habits and to not let credit card debt get out of control. Mistake number 4. Not having an emergency fund. Not having an emergency fund is another common financial mistake. An emergency fund is a savings account that you can use in case of unexpected expenses, such as a job loss, medical emergency, or home repairs. It's important to have an emergency fund in place because it provides a safety net that can help you avoid going into debt. Without an emergency fund, unexpected expenses can be financially devastating. You may be forced to rely on credit cards or loans, which can lead to debt, high interest charges, and damage to your credit score. An emergency fund can help you avoid this by providing you with the financial resources you need to cover unexpected expenses without going into debt. To avoid this mistake, it's important to set a goal to save 3 to 6 months' worth of expenses in an emergency fund. This will ensure that you have enough money to cover your expenses in case of an emergency. It's important to note that the amount you need to save in an emergency fund will depend on your individual situation. For example, if you have a stable job, you may be able to save less than someone who is self-employed. It's also important to choose the right type of account for your emergency fund. Consider using a high-yield savings account, which typically offers higher interest rates than a standard savings account. This will help your money grow faster. Avoid using accounts such as checking accounts or CDs, since they have penalties for early withdrawal. To build your emergency fund, consider setting up automatic contributions. This way, you don't have to worry about remembering to transfer money each month. You can also set a specific goal and work towards it. Failing to have an emergency fund is a common financial mistake that can lead to debt. To avoid this mistake, set a goal to save 3 to 6 months' worth of expenses in an emergency fund. This will ensure that you have the financial resources you need to cover unexpected expenses without going into debt. Consider using a high-yield savings account and set up automatic contributions to make saving easier. Remember, an emergency fund is an important part of a solid financial plan, and it will give you peace of mind knowing that you are prepared for the unexpected. Mistake number 5. Not having adequate insurance. Not having adequate insurance is the last, but not the least common financial mistake. Insurance is an important aspect of managing your finances, and it's essential to protect yourself and your assets from unexpected events. Without proper insurance, you may be at risk of financial ruin if you suffer a loss, such as a car accident, medical emergency, or natural disaster. One of the most important types of insurance is health insurance. Healthcare costs can be expensive, and without insurance, they can quickly add up. Health insurance can help you pay for medical expenses, such as doctor's visits, prescription drugs, and hospital stays. Without health insurance, you may be forced to pay these expenses out of pocket, which can be financially devastating. Another important type of insurance is auto insurance. Auto insurance is required by law in most states, and it can help you pay for damages or injuries you cause in an accident. Auto insurance can also protect you if your car is stolen or damaged by a natural disaster. Homeowners insurance is also essential for protecting your home and personal property. Homeowners insurance can help you pay for repairs or replacements in the event of damage or loss from a fire, storm, or other natural disaster. It also provides liability coverage in case someone is injured on your property. It's important to review your insurance coverage regularly to make sure it meets your needs. As your life changes, so will your insurance needs. For example, if you buy a new car or home, you'll need to update your insurance coverage. Also, if you have kids or are planning to have kids, your insurance needs will change. Not having adequate insurance is a common financial mistake that can leave you at risk of financial ruin. To avoid this mistake, make sure you have the right types of insurance, such as health, auto, and home insurance. Review your coverage regularly and make sure it meets your needs. Remember, insurance is an important aspect of managing your finances, and it's essential to protect yourself and your assets from unexpected events. That's it for today's video on the top 5 financial mistakes to steer clear of. But don't forget, it's never too late to get in charge of your cash flow and make smart financial moves. Just knowing these mistakes can help you steer clear of them and take the first steps towards financial freedom. So be sure to hit that subscribe button and stay tuned for more helpful tips and tricks on personal finance. Thanks for tuning in, and we'll see you in the next one.